if gold and silver prices go up, gold and silver in the ground are going to go up, 10x in my opinion. So I think that's where I get so excited about this, because it's kind of like an old school market where not a lot of folks are looking at, because it's not technology, it's not sexy, and it's for me, it's really where the opportunity lies ahead in the following years.
All right, Mr. Tavi Costa, welcome to On the Margin. Thanks for joining me.
Thanks for having me. Looking forward to this.
Me too. We lost a good man. Shout out Teddy,
I know.
who unfortunately couldn't make it work for the AV stuff. We'll have to do this again in like a little bit. Get the three of us back here. But Teddy, we're pouring one out for you here, my friend. Okay, man. Well, we got a lot of stuff to cover here, but I'd actually love to just kind of get your thoughts. So we talked a couple of months ago, basically, and back in January, February of this year, everyone was sort of focused on the reflation trade, right? And there was a lot of focus on being paid attention to kind of the 10-year yield. Ever since then, things have kind of backed up. So the yield has kind of stalled out, kind of topped out at 1.75. It's back down to 1.5%. Now no one's talking about reflation. Instead, there are kind of these two diverging narratives, right? On the one side, you kind of have the camp of inflation, and there's this rampant monetary and fiscal stimulus, and you're starting to see a rise in kind of commodity prices like lumber. There's tightening labor markets, etc. On the other side of the coin, you're starting to see deflationists, right? And they're saying, look, there's too much debt to GDP, there's this demographics overhang, and you're really starting to see these diverging narratives. So I guess like post-COVID, what do you think kind of about the state of the economy, and do you see us kind of moving towards inflation or deflation?
Well, I continue to think we're just relocating the issues from the private sector to the public sector. That's still happening in a huge way. In other words, we're seeing households looking better. Financially speaking, especially the bottom 50%, as I said before, the wealth transfer situation, and the government still is incredibly indebted. And so when I look at this two prevailing narrative that you were referring to, the inflation versus deflation, both have a lot of important arguments to consider. I'm more in the inflation camp, and it's really because I think the policymakers will overshoot their policies, and therefore we may see a beginning of long-term inflationary problems. But I respect a lot of the deflationary aspects of what we're seeing, and for me, that's mostly on the valuation side of markets. When you look at risky assets, equity markets, record levels in terms of valuations across median and aggregate calculations from EV to sales, free cash flow, PE ratio, CAPE, and so forth. When you aggregate all of those, clearly we have valuations we haven't seen before, and the reckoning of those certainly is very deflationary. So what does what's the positioning from a market perspective that really fits right in between those two narratives? In my opinion, is the commodities to equity ratio. It continues to be that. If you're right about deflation, I think equity markets are not supposed to be where they are, and so we're going to see a reset of valuations that will create upper pressure in this ratio, where commodities to equity ratio will actually rise, but mostly driven by the denominator, where will be falling significantly, similar to what we saw in the tech bust or in the global financial crisis. The other side of the coin here is the commodities trade, which some folks are calling it the peak of a bubble. I don't know what chart they're looking at, but the chart that I look at going back 30, 40, 50 years, I see commodities still near all-time lows. And so I like the optionality of a lot of the precious metals, especially monetary metals, giving we can get into the three pillars of inflation that we have today, and why I believe that we're going to enter long-term inflationary problems. But I think monetary metals is even more of a reason for you to be allocated towards that relative to other cyclical commodities such as copper and other things. I mean, at the beginning of the year, I was very bullish in oil, not so much in copper, even though copper moved quite a lot. Right now, I think silver is now the most asymmetric trade compared to that, and I still think silver is a still below $30 an ounce, and gold is headed much higher. Again, it can work in an inflationary and deflationary environment, which is the nice thing about it. But it's important to point out, a lot of moves that are happening today, in my opinion, that are kind of under the surface. We can talk about that later as well.
Yeah, for sure. I'd actually love to get into that. What are the kind of the three pillars of inflation in your mind, or what are the central tenets?
I would say, well, let's start with the demand side. It's what we learn in economics, but just the demand, the plus, the sort of the supply issues that we're seeing, and also the monetary dilution would be the three. But the first one being the demand started really with personal savings shooting up to $6.5 trillion back in April or so of 2020. Unleashed somewhere close to $3.6 trillion of consumer spending, which is about 7.5 times what we saw historically on an annual basis. And so that gives you a perspective. Why am I talking about this? Is because we're shot up to $6 trillion last month again, and I think we're going to unleash somewhere close to $4.5 trillion of consumer spending given the reopening of the economy right now. So that's a significant part of that. And the second part of it is what I talked before, which is the wealth transfer. When you look at the bottom 50%, the net worth of those folks, back in global financial crisis, declined about 84%. We're seeing an increase like we've never seen before, over 20% increase year over year, which is the largest increase in history. You can see that in other parts of the society. We're also seeing an improvement in the balance sheets of those folks in a way that we haven't seen before. And then it comes down to the other part, which is the cost push, which breaks down into two parts really. The supply issues that we were talking before, using the roadmap of 1919 Spanish flu, which is so accurate when you look back. And so what we're seeing now was a reacceleration of consumer prices back in the 1919 times, really because of the supply constraints that we had, not so much because of the aggregate demand that was growing. Very similar right now, but everyone is talking about this now. But the second part of this is the labor shortage, and I think we're entering a moment where the last 30 years that we had, wages and salaries falling, especially I would say at least the growth wasn't in an upward trend, was in a downward trend, and I think that's about to change. That also happened in 1919, where 1 out of 5 folks in the U.S. in the labor market of the U.S. was actually engaged in a strike, in a labor strike, and so I think this is sort of what's going to happen. We see McDonald's and Chipotle already raising wages, and as the cost of living increases here, given consumer prices also rising, I believe strongly that we're going to see a pressure from workers to or demanding higher wages and salaries. And the third one finally is monetary dilution, which a lot of folks are looking at the Federal Reserve's actions and policies and trying to really put into a framework of the dual mandate, especially obviously the full employment situation and the stability on the inflation side, when really all that matters is the suppression of interest rates that creates a supercharged environment for tangible assets. And so for me, those three pillars really running at all cylinders right now is what comes down to the high probability of entering long-term inflationary issues, which in my opinion will change the landscape of investing as we saw in the 70s and the 1910s as well.
Do you ever consider the possibility of, how do you weigh the kind of probabilities in your mind of a stagflationary versus an inflationary environment? Because when I kind of look at the environment that we have right now and the reason we have all this currency dilution, currency debasement, et cetera, it's arguably because we haven't been in the growth environment that we've wanted to be in for a long period of time. And to compensate for that, you've had kind of rampant central bank, money printing, borrowing, whatever you want to call it. There's been kind of currency debasement. So do you think, how do you kind of weigh those possibilities of maybe we're going into an environment where central banks continue to print, dilute the money supply, et cetera, but we don't see growth in that stagflationary versus what I kind of consider like a growth, but also like inflationary sort of environment?
Well, I think you got to look at, again, the optionality of assets that can perform in both environments and look back in history in places where we have very different scenarios. I would say the classic example of an inflationary setup would be the 70s in the U.S. or the 1910s, where commodities did really well. Equities not so much. Equities are actually, in nominal terms, barely a return over 1% when you consider inflationary forces at those 2 decades, the 10s and the 70s. It was, it was very negative in terms of real returns. And so that's we had, when you look at the quant factors that really helped us to select securities over the last decade or so, I would say most of the most successful ones were very focused on top line growth. And I don't think those factors are also cyclical. So when you're trying to understand the probabilities of entering new scenarios, usually you see those factors at a times of a positive deflationary environment. I don't think that's where we are. I think that's we're entering a new regime where I think profitability is going to start mattering, and especially cost of capital rises. It's going to squeeze the margins of a lot of companies. It will make those the profitability become a priority again for investors, and so that's why the leadership of the market structure is changing significantly. And we're seeing MicroStrategy down 65%. We're seeing Coinbase down 47%. We're seeing I'm talking about from the peak. We're talking about ARK down 30%. Specs down 20+%. SoftBank is one of the most successful business models of the last decade, down 30%. We have Chinese stocks down 20% or so. Tesla down 30%. Those are all very important leaders of the market. Alibaba down 30+%. And so I think that's all changing while we're seeing natural resource industries doing very well. That is not to say that's the end of the world or anything like that, but there's an importance to really emphasize this change in leadership, which I think is here to stay. So, in my opinion, in order to assess the probabilities of inflation versus deflation, you have to look at one, the market environment, which is highly somewhat of a speculative environment, even on the crypto assets part, in my opinion. But the second side of it is the policymakers are really overshooting their goals, and so we're seeing fiscal policies is still also at levels we haven't seen throughout history, even now after economic activity has returned to also levels we haven't seen throughout history. You look at the own Federal Reserve Economic Activity Index. We haven't seen anything like this before, and so I believe strongly that those policies will, in a way, create inflation if they continue to do so. The second option, that's why I say that the Federal Reserve is trapped, would be tapering and removing that from the markets. And I think the dependency that we have created already in record valuations that we see across almost all risky assets outside of commodities, in my opinion, really is what concerns me. And so I respect the deflationary thesis. I think that's it's why we have so many hedges in our portfolio, especially shorts in the equity markets, and why I keep an eye on the leadership, and I keep an eye on factors that are changing. Why? Because I think free cash flow growth is going to become a priority again. Margins, strong margins, are going to become a priority again. And when I look at the miners making as much money as they are, and the party hasn't even started with precious metals rising, I think that's why I'm excited about this whole industry.
Yeah. I definitely want to get into kind of precious metals and what you guys are doing at Crescat there. But first, you mentioned this idea of the Fed being trapped. And you have this great, I think it's your pinned tweet on your Twitter profile, but this great thought. Can you just kind of explain why it is that you think that the Fed is trapped in the current position that they're in?
Well, it comes down to this tsunami of issuances of treasuries that we're seeing. And so, a lot of folks looking at their policies and think, well, look, if you have a brain and you look at the macro data, they shouldn't be doing what they're doing. You can call it a policy mistake or whatever. Is it a policy mistake, or they don't have an option? I think they don't have an option. So whatever you want to call it, clearly they have to suppress interest rates. Just in the last 2 months, to give you some context, we saw about $600 billion of issuances of treasuries. We didn't see much of, no kidding, we saw yields rising in the last months or so, but the Federal Reserve only bought about 25% of those treasuries, and I'm talking about notes and bonds mostly. Why is this so important? Because when you compare, you look at how much issuances we've had of treasuries in 2020, and we saw how much the Federal Reserve and the banks, the U.S. banks actually bought of treasuries. They funded basically 60% of all the stimulus that we saw back in 2020. The real complex part of it is that 2021 we're going to see even more fiscal stimulus on an aggregate basis, and the issuances should also be drastically higher, or at least as high as it was in 2020. And the question is, how are they going to taper? And if they're buying already less than what they bought in 2020, and so why we're seeing pressure in nominal rates increasing, it makes a lot of sense. And so, in my opinion, it's very difficult. Right now, we're seeing inflationary forces picking up. Cost of capital is rising. It's becoming harder for companies to continue to pile on more and more debt. Corporate leverage is at all-time highs. And so, how does, we all remember what happened in 2020 in March when the crash happened. What was happening with corporate bonds? I mean, corporate bonds are all over the news back then. Liquidity completely dried up, and the Federal Reserve had to step up in an illegal or legal way, whatever you want to call it, in order to fix the situation, and say that they were going to start buying corporate bonds now. And so I think this environment is created the speculative setup that we've seen so far. It makes a lot of sense. But how did they move from here? Did they stop printing money and buying treasuries and allow we have a normality of a reset of valuations in the equity markets? Because I don't think the equity markets deserve to be where they are if we're going to remove the purchases we've seen so far in terms of treasuries of $80 billion a month on top of $40 billion in mortgage-backed securities. On top of it, mortgage-backed securities, why are they doing that? Why are they buying those $40 billion of mortgage-backed securities? Well, the bottom 50% owns about 40% of their assets in-house or in real estate. And so, it's against inequality. In other words, you're going to be increasing inequality issues if you do that, if you remove that from the market, because you're going to basically create an upper pressure in mortgage rates, and that's going to create a problem in the housing market as a whole. And so, they're trapped. There's no way around this. In my opinion, they have to continue to print money. And that's why I have a position where I think there's a high probability we're going to see inflation, number one. Where monetary stimulus is one way to pay for fiscal stimulus, is the only way that allows the government to be spending what they're spending. And on top of it, we have a twin deficit problem. It's not only the fiscal side of it, but it's also the current account side of it that is also very negative. And so, look, it's not the end of the world. I'm not trying to sound like a doom and gloom guy, but I do think that we're going to see inflation coming out of this. Can we see a reckoning of equity markets first? Sure. And if that happens, a position where you have shorts in equity markets and long commodities, you may get hurt on your long side, but you're certainly going to be protected on your downside with the equity market shorts. So I like that positioning quite a lot. And when I look at the commodities to equity ratio at a 50-year low or so, for me, that's where you want to be.
Yeah, absolutely. I guess one thing that's kind of interesting is we might be setting ourselves up here for almost like a good news is bad news type environment. I don't know if you were kind of looking at the jobs report that came out last week, which missed expectations, but actually stocks or equities kind of rallied slightly on that news. And if you think back to March of 2020 when COVID was all coming out, there was that steep drop. Right, the Fed then essentially unloaded this bazooka of monetary stimulus, and markets took off, and they haven't really looked back ever since that. And what everyone has kind of agreed on is that what the economy or what the stock market is trading on right now is basically just interest rates. So there almost might be this weird counterintuitive feedback loop where when the real economy is picking back up, the expectation of growth comes back, yields kind of rise commensurate to that. Everyone starts saying, well, that stimulus that the entire market was trading on is actually probably going to go away, so equities kind of revert. Do you think we're kind of in that environment? Is that correct? I don't know. What do you think about that whole framework?
No, I think I would just frame it a little bit differently, but I think you're right. I think we've had a disconnect in 2020 where the markets were, especially financial markets as a whole, were rising significantly at a time when it almost seemed like we're in one of the deepest recessions in history. And so I think we're seeing the opposite of that now. I don't like to say I was calling for this, but it's something I suspected was going to happen, was a disconnect on the other way around, which was the economy goes back to normal in a way. At the same time, we have financial markets not returning or seeing the same level of growth that we saw in 2020. But certainly we saw that there's a lot of signs of speculation in the equity markets as a whole, and why I think that we're probably we could potentially be reaching a peak here. It doesn't look like the tech bubble. The tech bubble, when the tech stocks really started to falter, the market began to falter as well. It looks like a little bit more of the housing bubble set up as a market, not as a speculation, I would say. Speculation sounds like more of the tech bubble, where housing stocks in general, especially home builders, began to really peak in late 2006 and beginning of 2007, way before the equity markets really fall apart. And so it's kind of what we're seeing right now. I gave you a list of stocks that are or indices that are having issues recently, and I think that will continue. We call this the great rotation from high multiple names to really value names, and I think the natural resources play a huge role in that part of the market. So I do think that there's improvements in the economy, but mostly, like I said, it's not that the economy is improving organically. It really is a relocation of the imbalances out of the private sector from households, especially, not so much from corporations. Corporations are still highly leveraged, as I said before. And that's another issue from the Fed trapped argument. It's we've had if you look at corporations in terms of their balance sheets, are worsening to levels we really haven't seen throughout history in terms of total debt to total assets. And you compare that with yields for the corporate bond yields, also near record lows. And those two lines, when you look at a chart of that, they used to follow each other very closely. And right now we have this disparity of the two, which was caused by the easy money policies. So this is really the first time we're seeing corporate bond markets and also the equity markets at record valuations. Not even in the tech bubble we saw this. The corporate bond market wasn't as overvalued as it is right now. It's difficult to find anything that yields more than inflation. And so it's created an environment for tangible assets, certainly, and why we saw Bitcoin taking off the beginning of the year. What you got to be careful is when things become consensus, and I think that's what was the case here with Bitcoin. Can commodities become consensus trade? Probably. A lot of the kind of cyclical ones, the coppers of the world and oil, could certainly become a consensus trade too, and create more of a higher probabilities change over time as well. And if we see that, there's a higher probability of more of a deflationary bust rather than an inflationary one in the short term. So I'm always focused on those. And right now, I do think that there has never been such a case, a perfect macro case for precious metals, and why a majority of my time is being spent on that part of the market.
Yeah, absolutely. I wanna get into kind of precious metals, but before we do, I just want to make sure I'm presenting like the devil's advocate deflationary case. So I'll just kind of say that, and then you tell me what you think. Because on the one hand, you could kind of sometimes I almost think about looking back 10 years from now, what is this going to look like? And on so many levels, all of that stuff that you just said was super compelling, right? Be like, look, guys, at the end of the day, when you print trillions and trillions of dollars, right, and you even move from the monetary side to the fiscal spending side, there's rampant money creation. Of course, there was going to be inflation. On the other hand, right now, I think some powerful counter arguments is that, number one, you still have debt to GDP at all-time record levels, right, which is really deflationary. If you kind of take the Lacey Hunt side of the argument, it's like 30%, right? 30 cents on every dollar that's essentially earned in a form of GDP is going to paying down that debt, which is really deflationary. You also kind of look at demographics, right? The demographics of the US look okay, but if you go over to Asia, the Asian demographics, that does not look great at all. Very, very deflationary sort of setup there. And if you think about the setup of globalization over the course of the last 50 or so years, we've essentially subsumed a lot of that population into our own working population, so that really impacts us. And then lastly, actually, a rising commodity prices, that's almost deflationary in a way as well, right? Because stuff starts to cost more money, and that actually ends up being kind of deflationary to growth. So I guess all of those arguments, what would you say to, have you thought about those? Like, what do you kind of think about that kind of counterpoint to the inflation narrative?
Well, the valuation aspect is I don't only think about it, but I'm positioned towards it too. But I would say the money velocity is probably the biggest argument of all, and Lacey Hunt and some others have been leading the pack in terms of that. And I would say, to them, I look at a chart of money velocity, or all the way back to the 1900s. And what I see there is that there was a bottom in 1947 or so. And there was also, which was exactly where it is right now. We are at the lowest level since the 1946 or so. And so I think that there's an argument to be made that we might be bottoming in terms of that as well. One of the reasons why money velocity really bottoms in a way is because of this inflationary forces creates an issue where you're not able to really continue to grow money supply at the same level, and therefore that ratio it starts to rise significantly. So there is a chance for that. But the whole reason why I like gold is because you have this argument where this optionality of working in an inflationary and deflationary environment is so important. And the biggest case for the deflationary environment that you're referring to would be Japan. The BOJ assets is about 130% of GDP today. BOJ assets relative to the overall market cap of Japan is about 100%. Maybe there's a case we're heading towards that direction. We didn't see inflation. Inflation in Japan right now is negative yet, still, and current account is still positive relative to GDP in Japan. And when you look at gold relative to the Japanese yen, I remember the days when Japanese yen was a safe haven, and now we're seeing this divergence between gold and the Japanese yen, which I find it very interesting. Also, I'll suggest another idea. Look at the performance of gold relative to Japanese stocks, and you see clearly that gold has performed much better than that. I think gold is such a kind of a slow mover asset, but it creates so many other opportunities as it triggers value in other chains such as silver and the miners and so forth. And that's why I like to be focusing more on the performance of assets rather than the probabilities of inflation versus deflation, even though that's incredibly important. And I have a view on it. I do think it's more of an inflationary environment than a deflationary environment. Look, I think Lacey Hunt is correct. There's so much debt in the world that is in a way hurts consumption. But when you're removing this from the household side and putting on the government side, where you do have unlimited power to print money and start monetizing that debt, which is basically what the Federal Reserve is doing. Okay, you can go down to the complexity of it and say, well, it's not exactly what monetary monetization of that looks like, but it's very close to it. It's basically the same thing. They're not buying directly from the Federal Reserve is not buying directly from those auctions, but it's getting from the banks. It's creating the same environment where you're suppressing interest rates, and the Federal Reserve needs to own those because the ownership of foreign investors in terms of treasuries have been declining for a long time, and it's hard to see them funding the government here going forward. And so in my belief is that the Federal Reserve will continue to be the buyer of last resort of those treasuries, and so that suppression of interest rates at a time when investors continue to buy tangible assets and hoarding anything other than cash will create a reacceleration of consumer prices, higher cost of living, pressure on wages and salaries. And that's what really creates inflation. And so we really haven't seen this in the last 30 years. So it's easy to make the other argument and easy to dismiss a lot of the issues we're seeing. This is not the global financial crisis or the post times of that period, 2010s and 2011. This is very different. We're not seeing the same. We're coming out of not only a pandemic problem, but 10 plus years of underinvestments in the commodity space. And so when I hear all this temporary issues or that's all going to be transitory, I think there's a lot of lack of understanding of how the commodity markets really work. I mean, we're seeing record low capex for a lot of different commodities, from the oil side to the precious metal side to the copper side, that we haven't seen in the past. I mean, this is a period of underinvestments that are really going to create a acute problem, in my opinion, going forward in terms of supply. And so I think that's where should be the focus. But certainly, yeah, there's quite a lot of arguments, and it will always be the case. There's always going to be the second side of the argument for inflation, which is the record amount of debt and the money velocity.
Yeah, absolutely. Well, let's get into it with the precious metals. I would love it. I mean, you guys are doing so much interesting stuff with this at Crescat, but I would actually love if you could even just say, look, the three that I kind of want to focus on here are silver, gold, and copper. I'm not sure if copper actually kind of falls in that category, but there's a lot of focus on it right now. So can you almost just describe, like, what is the investment case? Like, why does someone buy gold versus silver versus copper? Like, what are the difference between those three precious metals / commodities?
Well, I think, look, it all started for us in 2019 when we were looking at the yield curve inversion problem in the markets, and we saw our empirical research was showing that clearly gold and silver performs better than, or at least gold performs better than equity markets for the next few years. And then we saw the pandemic problems. That ratio shot up, significantly, but it wasn't really created by gold actually appreciating. And then the post moment was really where gold started to really rise right after that March lows. Those March lows where the miners were really leading the way. In my opinion, is really obviously negative interest rates in terms of real rates is one of the main factors for that. But there's a lot of issues. On the supply side, on the demand side, I would say the level of imbalances on the macro side is really what drives the demand for gold. But I think very few folks are really looking at the supply side of the issue, and the supply side of the issue is arguably even worse. I'll give you a few examples. I mean, just looking at the depletion of reserves of the majors in the precious metal space. Right now we're seeing a steep decline there, and so those majors or producers are going to have to be really buying or exploring in order to really expand their production line. And so, in our view, as we see gold and silver prices rising significantly, we're going to see really an improvement fundamentally of a lot of those larger gold and silver companies. And so they're going to start looking for new deposits, new discoveries of gold and silver in order to expand those production lines. Also, we're seeing a capex divergence between aggregate capex of the miners relative to gold prices. For instance, silver was up 50% in 2020, and you look at capex for silver producers was down about 26% year over year. So we don't see that throughout history. Usually, when gold and silver prices rise, those miners get really optimistic. They tend to spend more. They overshoot, and then we see some sort of bubble, and therefore everything bursts, and then we have another reset of valuations. That's basically what happens throughout the history of any commodity. But this time around, we're seeing a reluctance of a lot of those miners to spend capital in general. And so, we're seeing their improvements in their margins in a way that we haven't seen before. About 73% of the miners in the top 50 miners in Canada and US exchange are actually profitable on a free cash flow basis, the largest percentage we've seen in history. And so you look at free cash flow in aggregate terms, it almost looks like a tech stock, in terms of the last 30 years of prices of exponentially growing in terms of free cash flow. And again, gold and silver prices haven't really started rising just yet, in my opinion. I think we're at the secular bull market for those two. And as an investor, you have a few options. If you start getting very constructive on gold, you immediately start looking at silver. Silver is the high beta version of gold. If you look back in the 70s, it's really what led the way. Silver is, gold to silver is undervalued relative to not only gold, it's undervalued relative to equities, it's undervalued relative to money supply, to the monetary base. And so that's a few reasons why I like silver a lot. And it also fits the green agenda. It's not only a monetary asset, but also is an asset that is involved in this transition from the old to the new economy. And so we're going to need silver to really create all the innovations that we're talking about in terms of electrical vehicles and the electrification of the world as a whole. And so I believe that when you look at the amount of discoveries of gold and silver in the last 3 years, we haven't seen any major one, new discovery of over 2 million ounces of gold equivalent. We haven't really seen anything like it. And so that really is the reason why on the supply side, we started focusing more on the discovery and exploration side of the industry, because we think that those majors are going to start getting cashed up. They're going to improve fundamentally, and they're going to start looking for other parts of the industry. Investors tend to, there's quite a lot of ways of investing in this. I mean, you can go to the GDX and GDXJ members, pick and choose and try to do your best and performing better than the ETF. That's a fine strategy. I know a lot of folks that do that. You can look for the developers in the industry of the mining, where a lot of financially savvy folks try to navigate that space, and they do very well. That's another fine strategy, but we rather partner with a geologist and focus on a part of the industry that no one is actually focused on, which is the exploration and discovery. Companies that are actually 5, 10, 20 million market cap that could be worth $1 billion if they do have a discovery and they do have gold and silver in the ground in a bull market for gold and silver. So there is a lot of leverage to the prices of commodities in general, but also they're not priced according to the opportunity. And so by partnering with a geologist, I have the very high probability of making really two aspects of every trade that I put on a portfolio, which is making more of an activist approach of helping those companies to achieve what we think they could achieve in terms of the discovery process. And the second part is the macro trade, which is if gold and silver prices go up, gold and silver in the ground are going to go up 10x in my opinion. So I think that's where I get so excited about this, because it's kind of like I guess the old school market where not a lot of folks are looking at, because it's not technology, it's not sexy, and it's for me, it's really where the opportunity lies ahead in the following years.
Yeah. So for me, like when I think about something like gold, especially, I kind of think of it as this protector against governments stealing the time of their citizens, right? Because ultimately, when you look at money, like wealth, what that really is, it's kind of the protection of your time and energy. So when governments print a lot and debase currencies, they're essentially stealing wealth from their citizens. So that's why I think gold and silver, as a high beta version of gold, do so well when they're negative real yields, right? Because that essentially means that you're in this environment of financial oppression. So I totally get, and I'm also excited by kind of the precious metal space. You just, kind of said a whole bunch of different stuff about like where you guys are choosing to focus. Like, let's just say I'm an investor and I'm trying to understand what's the best way that I should be getting exposure. What are the different ways that are available for you to do that kind of in the value chain? And how did you guys decide on this area of exploration? Like, how did you come to the idea that that was the best kind of risk reward for Crescat?
Well, it all started from a macro level again, where we think we are at a secular bull market for gold and silver. You don't want to be messing with, very illiquid assets or more illiquid assets at the peak of a bubble or anything like that. I don't think that's the case here with especially silver names. That's why we feel so comfortable building a whole business and shifting our focus towards those small cap kind of names. Really, they're not even small. They're really more than micro cap. I mean, we're talking less than 50 million market cap. I mean, it's nowhere close to what we tend to see folks talking about in the markets out there. Look, I think there's, like I said, it's a fine strategy if you want to if you divide up the mining industry, you can buy the royalties. That's the safest part of the bucket. The second one is the more consistent, for cash flow generation businesses, the gold and silver miners, such as the I would say Barricks of the world, the Newmonts of the world, the Kirklands of the world. Those are the ones that fit in that category. You can create, a lot of different value factors to pick and choose which one you think it's going to perform better. The second part of this is developers. The developers, are those really trying to create a mine. They don't have free cash flow most times yet, and so you can kind of have an idea of how they will perform in the following years if you think that the project that they're creating will be in place in the following years too. And so a lot of folks are capable of making those assertions and in navigating that part of the market. In my opinion, where it really lies ahead. I mean, if I look at the whole market, and I think we're in the secular bull market for gold and silver, and I think silver is supposed to be at at least at all-time highs right now, and it's significantly lower than that. It's about even close to 40% from its highest price in history. I think that it's there's an argument to be made where you want to be going up in the risk curve. And looking for the most levered way of playing this environment without taking any debt. And so that's what I like about this. I go back in exploration space, and I think there's a niche to be created here. There's or focus is I don't think there's anything that can be matched in terms of a strategy. I don't think there's any, there is no other money manager doing what we're doing. And so that's why we thought that this would create a lot of value. We want to be the new companies or be involved with the companies that are the new discoveries of the following 5 to 10 years. And look, I mean, there's so many issues in this space. I mean, it's it's hard to find good CEOs. It's hard to find quality companies. It's hard to find assets that are in safe jurisdictions, and it's you talk to the majors, they're not even I remember talking to them 6 months ago. I think I said this before, but none of them had any interest in looking at copper assets, for instance. And I was like, why not? This is a kind of an interesting setup for copper. Why you guys not looking at buying copper assets at such cheap levels? And now, after copper prices reach the levels that we're seeing recently, we're seeing a lot of those gold miners begin to buy a lot of those assets. They're always late to the party. And my question to them recently was, well, are you guys looking into, we have this new discovery, perhaps you guys could get involved and start really expanding your production line. This is already a discovery. We do have gold and silver in the ground in this property. Is there any interest where you guys want to get involved with a small stake or anything like that? And the answer is no. And so we're so at the beginning of the kind of early innings of this precious metals bull market, in my opinion, where there's no acquisitions being made, and so everything is really capital is pretty it's not as dry as it used to be maybe 3-4 years ago, but it's still difficult to raise money for a lot of those businesses. And so you have to be our goal is to find the very high quality projects where they can actually do well in a bear market for precious metals. And that's the way I see risk management in space, where we've had a few Quentin Haney has been involved in a lot of companies that did very well regardless of how gold and silver prices are doing. Why? Because the biggest mistake we see in the space is folks buying large low-grade deposits because they're highly levered to gold and silver prices. If gold and silver prices grow exponentially from here, those deposits start to become profitable and worth something. And so that's why those assets tend to move up more in prices. But we like the high grade, the more lucrative, the more the economically viable projects that we can actually make money on silver prices at this price or even 50% lower. And so we think that there's a lot of value to be generated in space, and therefore why we like to be at the exploration and discovery. It's kind of like going up on the risk curve and really trying to maximize for gains on implementing an idea that we feel strongly about.
Yeah, you got it. So I feel like I have a pretty good grasp of kind of the investment case for gold, silver. Talk to me a little bit about copper. How does that differ? Like maybe if you could touch on its kind of industrial use case and like why would someone buy a copper producing asset, invest in copper as a commodity as opposed to something like gold and silver?
Well, look, the only reason why gold and silver are not as industrial as copper, even though silver has a lot of industrial aspects to it, is because of prices. I mean, if gold prices were cheaper, it would be an industrial metal. There's no doubt, much more than copper. But there's also if you look at gold and silver and copper, a lot of times it's hard to find a primary or either copper or especially silver mine. It's very difficult. So usually you end up finding other commodities along with it, and so we're seeing a lack of exploration budgets across the entire commodities space. for some time now in a way that we haven't seen in the past. I mean, you just look at the labor market for mining. It's difficult to find high quality labor. There's no drillers. How do you drill? There are no drillers available. The labs are all backed up. Labs don't have the infrastructure. When you drill, you take it to a lab to see what you found. The labs are all backed up, and so there's no enough infrastructure in the world today to take on a lot more new discoveries in the space. And so copper, the case for copper really is a lot has to do with a lot of people. It's kind of a conventional thought. I hate to talk about that because it's more of a conventional thought, but it has to do a lot with the electrification in the world and the green agenda. We got the perfect political environment for that right now. But it's funny that not a lot of focus on how are we going to get from the old economy to the new economy, especially with the scarcity of copper deposits worldwide. Tin is another base metal that is there's so many other base metals that should be the focus here to be looking forward if we're going to go really full green agenda in the next 10 years or so, which seems like that's going to be a good excuse or a good reason, whatever you want to say, for the continuation of large fiscal policies going forward. And so I think that the case for copper is more cyclical, it's more tied to the economy, it's more tied to where the business cycle really is, which I don't feel very strongly about in terms of that. I don't like the demand side of copper. Copper is not so much linked to the imbalances in the macro world, which gold and silver mostly are, especially gold. And so I'm not as bullish on copper, even though we buy good projects. I mean, there's a lack of, as I said before, of discoveries of copper too. And so if we find something that is high grade and economically viable, we get involved. And so they're not priced accordingly either, which is the most interesting part about it. There's a lot of copper exploration names that are actually down year to date, while copper prices are doing what they're doing. So I think, in my opinion, as folks begin to realize this opportunity in buying land in general that have a high probability of finding gold, silver, copper, and some other commodities in the ground, will become more of a conventional trade in the future. It's still very out of consensus right now. And so that's why we like to be involved with this. When I go to a party and I hear people saying that they're buying properties to find gold and silver or copper, I'll be cautious. That's not what I heard. Every time I go to a party, they ask me if I'm a crypto trader. So, with all the respect, I mean, I think crypto is here to stay as well. But it's important to be aware of sentiment, in my opinion. And
Totally.
I don't think that we are there yet in terms of the sentiment for commodities. And so I think this is just the beginning of a super cycle. Can we have a drawdown with 20-30% and then get back to new high? Yeah, we could certainly see that. But I think the overall trend of the next 5 to 10 years is that commodities are going to do better than other markets.
Yeah, absolutely. And I can actually corroborate that. No one has ever asked me at a party either if I'm buying commodities. I do get asked about Bitcoin all the time, man, all the time. Okay, so I guess, just your thoughts on crypto for a second, because it's I'd be curious because, like, for me, I kind of look at, like, I had Grant Williams on this podcast a little while ago, who I have a tremendous amount of respect for. I know you were just recently on his podcast as well. The way that I hear Grant talk about gold and the way that I hear Bitcoiners talk about gold, or Bitcoiners talk about Bitcoin, even though it's different, and I know they've got the laser eyes and it's like really, frankly, annoying to watch on Twitter and all that kind of stuff, but the sentiment really seems to be the same. And there's almost this thing where it's like, look, they're seeing the same world, right? They're seeing the same problem, but the solution set is just different. And when you really think about gold and Bitcoin, I get it. There's this technological function to Bitcoin. There's this beautiful scarcity element to gold. But really, there's something kind of just arbitrary, right? It's solving this problem of negative real yields, financial oppression. And there's almost something arbitrary about we're just going to all pick this to buy as a protector for our time and energy when the governments are trying to steal time from us. So when you think about these two futures of, like, let's say gold and silver versus Bitcoin as a store of value. I mean, how do you kind of weigh those things out in your mind over the long term?
Look, in 2019, we wrote a letter, and I still stand by it, which we said, we wanted to take a position on Bitcoin, and we sold it way too early. And our idea was, this is sort of a call option on inflation. We get the technological advancement aspect of it, but we really thought that, this was, if we're going to see inflation and folks are going to start looking for, assets that have supply constraints, Bitcoin would be in the space. It would fall perfectly with kind of a tech world. Personally, I do think there's a larger participation of those types of investors in that space that understand much better the technology than others. I think that there's I agree with you. I think if you walk on the streets and you ask folks, I think most will agree that there is a lot of issues in regards to government policies and monetary dilution and so forth. And I think there's inflation is becoming more of a prevalent narrative among the average Joe. And so I just believe that also at a time when you have all the macro drivers to die for gold and silver, people are asking the wrong questions. They're asking, is Bitcoin going to replace gold? When that shouldn't be the question. That's gold and silver are commodities. They're actually real tangible assets that are used for different purposes than Bitcoin. And so I just find that type of question really wrong. It gives me a kind of a sense of the sentiment. Now, how many times am I speaking with prospects that want to invest with Crescat, and that's their primary question is that. And so, how are you guys seeing the crypto world, stealing the way? No, it may do that for some time, and we may see a lot of outflows from the commodity space into the crypto space. But in order to develop the crypto space, you need commodities too. And so I think it's a much better case to look at the overall equity market and see that as a higher risk than the commodity space, especially gold and silver. So I think there's a lot of wrong questions being asked in terms of that. And the differences between the two. You can kind of see when you are in a bubble environment, and sometimes bubbles can last for a long time. I mean, I thought Bitcoin looked bubbly even when it reached the 30,000. I had Bitcoin myself until the 25,000 or so, and then I sold it, and then we went up to 60. So who am I to talk about Bitcoin? But I just could tell that we were I had folks that I know. Friends and so forth asking me, what do I think about Bitcoin? That's not an environment where we are. That is an uncrowded trade where you make a lot of money. That is a crowded trade, consensus trade that a lot of people agree with, and so you got to be careful with that when that's your core investment. Again, if that becomes the case with gold and silver, I will certainly have to look for alternatives of other core investments for Crescat, but that's not the case right now.
Right.
I think in July we kind of saw some of that, and then we saw consolidation since then, where gold and silver technically look really attractive. I mean, it's been kind of a recharging mode in a recharging mode for some time now. I think we're just looking for a trigger to go significantly higher, and so. Look, I don't like to compare gold and Bitcoin. I think Bitcoin right now, you asked me if I went to the Miami conference, and no, but I did watch a lot of videos, and that does not look like the mid '90s. It looks like the late '90s to me. It's like the end of a party, not the beginning of one. You don't see those types of behavior at the beginning of a speculative bubble. You see it at the end of one, and so. But I don't want to, I want to welcome the crypto investors in the space, because I think, like you said before, I think we have very similar mindset. We both agree that there's a problem with the monetary dilution and the corrupt governments, and fiat currencies are in the race to the bottom. There's all agreements in terms of that. I mean, I think we all seeing the same issues, but how do we play this going forward? I think Bitcoin was an alternative. Maybe a few months ago. I know some folks are looking at this and buying dip. That's fine. That's a fine strategy. But I do think the sentiment still after Bitcoin is down so much is hasn't really changed. I mean, sentiment's still very. How many laser eyes you're seeing out there, as you said? We should have an indicator of laser eyes. How many laser eyes on Twitter would be a great indicator to look at as part of this. But I'm a little concerned. I think this could unravel much and have ramifications that are going to be very important for equity markets. It surprises me that we're seeing this sell-off in crypto at the same time. Look, I'm looking at right now my screen. Crypto down 9%. S&P is down 20 bips. We're basically at all-time highs. The S&P has done nothing in the last 2 months. Since April 16 or so, S&P is basically up 1 or 2%. So it scares me a little bit to see that divergence because, as I pointed out before, I think there's a lot of frothiness in the market in general that could unravel something a little worse in terms of reset of valuations for the overall equity market. So I'm very concerned about overall equity market. I like to watch the crypto assets that are here to stay. A lot of issues are, we're probably going to see a lot of issues, a lot of companies going bankrupt. But no, there's going to be a lot of winners too. And I'm not spending a lot of energy in that because it's a crowded space right now. And I'd much rather be focused on something that no one is talking about, which is exploration and discoveries of gold and silver.
Totally. And by the way, first of all, I'm part of the reason I was so excited to talk to you, so I didn't have to pay attention to what's going on with the price of Bitcoin. So thank you for reminding me while we're on this chat here.
Oh, I don't mean to be.
I'm just messing with you. That was a total joke, man. I'm totally messing with you. And look, honestly, here's what I want to say. So I'm not going to go out here and say I'm not somewhat biased about this space. I'm a big believer in this space. I think it is here to stay. I see a lot of growth potential. Clearly, I left my job to start a media company in crypto. I have a big stake in this industry and I care about it and I want to see it grow. What I will say, because I also didn't go to the Miami conference, and watching it from afar, what really worries me, especially when you look at reflexive assets like I think gold is, like I think Bitcoin is, the community is a really big part of it. And you can look at the meme stocks and say, this is an aberration, yada, yada. I think memes and online messages or whatever, that's the way that information is going to get distributed in the future. What worries me when I look at the Bitcoin community is this is starting to transform into a community that it doesn't look like you want to root for, because this was looking like an underdog thing, really, really cool idea, grassroots movement, and now you look at these people celebrating in like Miami clubs and the Dogecoin thing, and you just look at that and you say, this isn't really a future that I want to root for, and to me that deeply worries me. And I guess the last thing where I want to close on, I'd love to get your thoughts. I know you've already been super generous with your time, but when I kind of look at the world, I worry about a lot of the same things that you do. I worry about what governments and central banks are doing in terms of diluting currencies. And when you kind of look out at big markets around the world, I think one of the big things that I actually look at is the bond market, which is the largest market in the world. You've seen kind of this very steady decrease in yields, right, over the course of however long you want to zoom back. It's a super, super long trend. And that's essentially caused a bull market in bonds for the last 50 or so years. We've gone further than basically anyone thought we were going to go. We've crossed the zero bound in a whole bunch of different big markets. It's possible that we might cross it in the US. At some point, that's going to have to end. And at some point, that's going to cause a rotation out of bonds, right? So when you look at kind of the world in general, big changes in allocation, what is kind of the future that you see? Do you see like big permanent reallocations and shifts into things like precious metals, gold and silvers, commodities, like almost like a rebirth of like the real economy? What are the big asset, like global asset allocation changes that you see coming over the course of the next 10 years?
Well, look, I mean, if you look at capital allocators, especially the large ones, I mean, there's certainly a lack of exposure to commodities as a whole, but I would say especially to gold and silver. They have not. Silver is barely an allocation for most of those institutions, and this dynamic of record valuations across a lot of asset classes, especially relative to inflation expectations. S&P yielding less than inflation expectation, corporate bonds doing the same, treasuries, sovereign bonds all over the world, a lot of negative yielding bonds, and so it creates a place where you start looking for things that may appreciate in price rather than yield something. and that's what goes back to the commodity space. Back in the 70s, we were not talking about this new sexy tech company that was going to come along. No, the sector didn't even exist at the time. But it was a lot of investors in the news were all about commodities. Were about how corn was doing, how agricultural commodities in general, and in copper and gold and silver. This was really a much bigger market relative to the overall market than today. I mean, we're gold is what, a $9 trillion market cap, you would say, above ground of gold, but compared that with equity markets in the U.S. and globally, that's nothing, or to financial markets as a whole. So and that's why it creates a case for Bitcoin too, obviously, and case for crypto assets. I like it all. I mean, I just think that this dynamic of flows out of very expensive assets to more attractive ones, given this upward inflationary problem that we may see, there's a high probability with cost of capital rising, will drive investors towards not only protection of capital, which is gold is a probably one of serves the biggest role in that, in terms of not only protection but also in terms of lack of volatility relative to other assets that also serve as a monetary alternative, I guess, such as Bitcoin or silver. But that will drive other assets higher. If you go see gold prices in the bull market, certainly tends to be good times for you to be buying silver and other platinum and other precious metals that may benefit from that. So I think we've reached an exhaustion point for risk parity strategies, where mostly capital allocators have been focused in bonds and equities. And I think we're going to see a big change in capital allocation, not only from an asset class perspective, but if you look at actual equities, I think as we're seeing a change in leadership, I think this rotation from value to growth is here to stay. We saw a big move of that right coming out of elections, and then we kind of things stalled for a minute, and then we saw it again. I think we'll continue to see that for the next 3 years or so, and so I'm very focused on that as well. And so yeah, well, look, I'm with you. I mean, I respect people that will change their personal lives in general to really see an opportunity like you're doing with yourself, and really be invested in a way, not only in money, capital, but time as well, to learn about the industry and help develop something completely new. I just find it difficult for me to get involved at a time when I see this level of frothiness. I mean, it's difficult to see. I mean, when you see somebody telling you to take on debt to buy an asset, and believe me, the gold community it could become very frothy too. I mean, the gold bugs, they have that. I mean, if you look back in 2011, they were very, look back in the peak of 2011. I mean, I was looking at a few money managers that are very popular, still popular today. They were very large investors in the space. And you listen to their speech, it's not very different from what we're seeing in the crypto space today. And it's you got to be careful, because you may be right, but your asset may not perform you may have good reasons to own something, but given the sentiment and being a consensus trade may create a problem. So I caution most folks on that, but continue to build what you're building, because it's I think this industry and this community is here to stay. I think it's incredible what they built and you built in the last years or so, and I think it's going to create a lot of value as well. I just as a macro investor, I'm always cautious when my trade becomes consensus, and I think that's the case with cryptos here.
Yeah, I actually kind of agree with you. It's funny. I actually think in my heart of hearts, you kind of hear the growth versus value guys, and you kind of either have that value mindset or you don't. I think I really do. I joke a lot that my co-founder Jason dragged me into this, and this is entirely his fault. There's definitely a parallel universe where I'm sitting in your seat arguing for precious metals, so I completely understand the mindset. look, man, you've been super, super generous with your time. If people want to find out more about you, Crescat, all the exciting work that you guys are doing, what's the best way to do that?
Our website, Crescat.net, is one of the easiest ways, or Twitter. My Twitter handle is at Tavi Costa, and we put out a lot of content, charts, and letters, and also we now do a weekly presentation about some of the mining companies we get involved. So we tend to disclose one name every video, and then we discuss the thesis behind it. And I talk a little bit about the macro environment along with Kevin, my partner, and then we pass it on to Quentin to really elaborate on what's the geology reasons for you to own that name. And so it's been a very long learning curve, but it's if anybody's interested in learning more about this industry, I suggest you to look for on YouTube. Just type Crescat and you'll find it, all of our videos there.
Awesome. All right, Tavi. Well, everyone, I highly recommend you definitely do go check that out. Tavi, we'll have to do this again sometime soon, hopefully with Teddy in tow next time. If the audio gods are willing.
I agree. Yeah.
All right, my friend. Take care.
Take care, Michael.